We've been talking a lot about the accounting decision companies face when they use one asset, cash, to purchase another asset, like property, plant, or equipment. First, do we capitalize the expense by increasing an asset account on the balance sheet instead of decreasing retained earnings? And if so, what amount should we record for the new asset? Capitalization arises because the money we've spent is less about maintaining the day-to-day operations and more about investing in future revenue. That brings us to another important investment that companies often make in their future: research and development. And the way we reason through the accounting treatment of R&D is a little different than how we've been thinking about the purchase of long-term assets. Think about a pharmaceutical company. Its most valuable resource, the thing investors are really paying for, is its pipeline of drugs under development. Billions of dollars of research, years of work, enormous future potential. Now go look at its balance sheet. Where's all of that? For the most part, it isn't there. That's not an oversight. It's actually the rule. And at first, it seems to contradict everything we've done this week. We just spent 3 lectures capitalizing every cost necessary to get an asset ready for use: freight, installation, even interest. Research and development is spending aimed entirely at creating future benefits. Isn't that the very definition of a long-term asset? But here's the rule under US GAAP. Research and development costs are expensed as incurred immediately. No asset, no capitalization, no spreading over future periods. Why would GAAP take such a hard line? It comes down to uncertainty, really. At the time R&D money is spent, nobody knows whether it's going to produce a benefit. Most research projects fail, most drugs don't come to be. And even for the ones that succeed, there's no reliable way to verify at the time of the spending which dollars created the value. Rather than let every company make its own optimistic guesses, and rather than let managers dress up the balance sheet with hopes, the standard setters chose conservatism. Expense it all right away. The trade-off is exactly what we saw with that pharmaceutical company. For research-intensive businesses, the balance sheet systematically understates what the company really owns. As an analyst, you would need to know that that's baked into the numbers. So, what goes into R&D expense? 5 categories. First, salaries and wages of the scientists, engineers, and staff doing the research. Second, materials and supplies consumed in R&D activities. Third, and this is the one with a wrinkle, equipment and facilities used in R&D. If that equipment has no alternative future use beyond the research project, its entire cost is expensed immediately. But if it does have an alternative future use, say a lab building that can be used for other purposes, we're going to capitalize it like normal equipment, and the depreciation during its R&D use becomes part of R&D expense. Fourth, payments to outside firms that perform research on our behalf. And fifth, a reasonable allocation of indirect costs related to R&D effort. Now, a few exceptions. The situations where R&D type costs do get capitalized. There are 3 you need to know. First, software development. Once a software project reaches technological feasibility, that's the technical term, meaning the company has shown the product can actually be built, the development costs from that point until it's ready for release are capitalized. Before technological feasibility, it's R&D expense like anything else. Second, R&D performed under contract for others. If a customer hires us to do research and is paying us for it, that's not speculative spending. We have a buyer. Those costs are capitalized as inventory and matched against the contract revenue. Third, R&D acquired in a business acquisition. When one company buys another, the in-process research it acquires is part of what it paid for. There's a verifiable third-party price, so it is capitalized as an intangible asset. Notice the common thread. In each exception, the uncertainty problem is reduced. There's either demonstrated feasibility or an actual transaction that verifies that there's value there. One last contrast worth knowing, under IFRS, the research phase is expensed, but development costs that meet specified criteria are capitalized. It's one of the most visible GAAP IFRS differences, and it matters when you compare a US company to an international competitor. In the class exercises, you'll take a list of expenditures and sort them: R&D expense, capitalized expense, or some other expense category, and then compute total R&D expense for the period. The alternative future use equipment question will be in there, so watch for it. To summarize, under US GAAP, R&D costs are expensed as incurred. The future benefits are too uncertain to record an asset. R&D expense includes salaries, materials, contract services, indirect costs, and equipment with no alternative future use. The 3 capitalization exceptions are software development after technological feasibility, R&D performed under contract for others, and R&D acquired in a business acquisition. And IFRS splits the difference. Research expensed, qualifying development capitalized. That wraps up the acquisition side of long-lived assets. Next, we're going to turn to what happens over the years that follow: depreciation, depletion, and amortization, which you're going to remember all actually just mean to allocate.